CBN forbearance warning to banks. What is the actual situation? Should I panic? Listen to this. So a report in circulation by Renaissance Capital has revealed that several of Nigeria's most prominent banks are facing significant exposures to regulatory forbearance loans. That is how they manage their non-performing loans. The report suggests some are now likely to suspend dividend payments for multiple years as they work to meet stricter prudential standards imposed by the Central Bank of Nigeria. Recall that this Monday, 13 June, a CBN directive instructing banks with unresolved forbearance exposures were to halt dividend payments, defer executive bonuses, and suspend all investments in offshore subsidiaries. It was issued and it has caused a lot of commotion in banking stocks. The aim, the CBN said, is to strengthen capital buffers and ensure adequate provisioning against impaired loans, especially those that risk breaching the regulatory single obligor limit. The suspension is expected to remain in place until affected banks have fully provisioned for their forbearance exposures and phase them out entirely. Now, Renaissance Capital had earlier reported that nearly all Nigerian banks had some level of exposure to forbearance. And of course, they face restrictions on dividend payments. Now, what is Renaissance Capital actually saying? Now, according to their estimates, Zenith Bank, First Bank, and Access Bank rank highest in terms of forbearance exposure. Okay? Now, the research notes that Zenith Bank carries forbearance loans equivalent to 23% of its gross loan book. First Bank has an exposure of 14%, and Access Bank stands at 4%. Tier 2 lenders are also affected, with Fidelity Bank and FCMB carrying exposures of 10 and 8% respectively. Now, in contrast, GTCO and Stanbic IBTC have zero exposure to forbearance loans, having already cleaned up their books. No wonder this morning, while other bank stocks were dropping in price, GTCO jumped to 78 naira and Stanbic IBTC hit 80 naira. GTCO in particular had proactively provisioned for and written off their exposures as of December 2024. Meanwhile, FCMB Group has also moved to reassure investors. In a statement issued just yesterday, the bank confirmed that it has made significant progress in reducing its exposure to loans under regulatory forbearance, bringing down the total from 538 billion in September 2024 to 207 billion as of May 31st this year. FCMB expects these loans to fully exit the forbearance regime in the near term. They also stated that it is still planned to pay dividends from its other subsidiary companies. Now, other banks are yet to release statements. And so, however, sources in Zenith Bank indicate there are plans to exit forbearance loans by the end of the year, stating that the bank's profit is significant enough to cover for the forbearance loans. This is why, for me, while others are panic selling their Zenith Bank shares at 43 and 45 naira, I will be buying. So after all these technical jargons, what am I saying? This is my take. And please pay very close attention. The analysis causing this current pandemonium in the banking stocks as we speak now was based on data from the first quarter of last year, 2024, for most of these banks, and may not account for the significant progress some banks have made since then in addressing these exposures. For example, according to the report, estimates for GTCO, UBA, Fidelity, and FCMB were based on recent engagement with the bank's management, while the forecast for Zenith Bank was drawn from a December 2024 interaction with the bank. Therefore, I am saying there is the need for a more recent update for all the banks. No bank is about to collapse. It's just shareholders reacting to the implication that dividends may not be paid by their banks for a while. So the banks have sufficient capacity to address the issue and clear their books, and will try their best to do so to assure their shareholders. That I know very well. Now remember, most of these banks have their founders as chairmen, who receive billions of naira every year as dividend. I'm talking about the likes of Tony Elumelu of UBA, Jim Ovia of Zenith Bank, etc. And they won't stand by to watch their major source of cash flow get stranded. You get my point now? So there is still a very good likelihood that dividends will still be paid, but not from their main banking subsidiaries. So while dividends may be paid just in case they don't meet up from their non-banking subsidiaries, these units contribute only a fraction of the group earnings, making any substantial payout unlikely in the short term. In my conclusion, I would say my advice is to buy the best banks at fantastic discounts while it lasts, because surely the biggest Nigerian banks are not about to collapse yet, and a lot will still change eventually when they all come up and make their current official position known in this matter. So if you learned something from this video, don't forget to share it to all your contacts, your family, and loved ones, especially your aged parents, so they don't go out panicking with the fear of losing their savings because they think another round of bank collapse is about to happen. Don't forget to hit the follow and like buttons while making your comments in the comment box.